Welcome to your private equity valuation tutorial. Before we begin, let me tell you a little bit about myself. My name is Joseph Abramson, and I'm the Chief Investment Officer at Northwest Capital. Before that, I was an analyst for a long-short hedge fund in New York, and I was a portfolio manager for TD in Toronto. I was also a strategist at BCA Research right here in Montreal. Beyond that, I have my CFA and MBA. So welcome to the wonderful world of private equity. It's quite exciting because you can get amazing deals since the companies are so opaque and so idiosyncratic. But it's treacherous for these exact same reasons. So why did I choose to work in private equity? Well, there's a few reasons. First of all, there's a good supply-demand balance. There's a lot of capital that's flowing into private markets and it's flowing out of public markets. For that reason, pricing is quite attractive. If you look at public markets, there's a lot of deflation in terms of management fees. That's not true in private markets. And over and above that, it's quite labor intensive. Because the deals are so idiosyncratic, as volumes go up, there has to be more hiring done. So the employment situation is quite positive, at least relative to the rest of the investment industry. On to the next slide. So how is Northwest positioned? Well, within venture capital, we tend to be involved in Series A financing, where companies have over $1 million in revenue with proven business model. That puts us in a very good position versus our competitors because if we look at the early seed or seed financing, there's hundreds of players in Quebec. If we look at the big deals, there's not so many players, but there's much more capital than the market can provide for. In between, there's a nice supply-demand balance where there's only about 4 or 5 players, so we're capable of getting good deals. If we look at traditional private equity investing, we're in the same sort of position. We operate in the smaller part of the mid-market, in companies that tend to be, older, cyclical companies, but generate lots of free cash flow, kind of boring industries. We're also looking for places where we can add value. So again, we're not facing that many competitors when it comes to deals because our deals tend to be too small for the big institutions, but too large for most individuals. Turn to the next slide, please. So what are the differences between public and private markets? Well, if we look at the private companies, they tend to be smaller, so that makes them much riskier. They're obviously much less liquid. But over and above that, if we look at the fundamentals, the fundamental earnings are more based on companies' personal taxes of the owners. There's also much less information, which is both a threat and an opportunity. On to the next slide. So here we get into the valuation proper. And there's really a wonderful quote by Warren Buffett. Price is what you pay. Value is what you get. And nowhere is this more true than in private equity. There's really 3 basic approaches. The first is the income approach. Here, we're looking at the present value of future cash flows. Next is the market approach. Here we're really looking at comparables, whether they're private or public, and providing some sort of discount. Lastly, there's an asset-based approach where we look at balance sheets. This tends to be used mostly in distress situations, so it's really the first 2 that are usually focused on in private equity. On to the next slide. So if we look at the key steps in terms of valuing these companies, first, we get the enterprise value to EBITDA multiples for the comparables. Then we perform basic free cash flow analysis. After that, we adjust for leverage. Then we adjust for operational improvement or synergies. And lastly, we calculate the IRR versus the hurdle rate. On to the next slide, we'll look at step 1, the application of the enterprise value to EBITDA multiples. So here we have some public comparables and we provide a discount for both size and illiquidity. We also have private transactions and we make many adjustments to both of these. The most popular ones are based on size, liquidity, growth, and cyclicality, but it's certainly not limited to those. Once we have a proper enterprise value to EBITDA multiple, we multiply it by the trailing EBITDA, and that's how we come up with our valuation. On to the next slide. So here we can see the tremendous discount applied based on size. Flip to the next slide, please. Before we complete the free cash flow, we first have to normalize the earnings. Some of the most important areas to normalize are CEO and family salary, rent and lease rates, and personal expenses. It's very important, but also very difficult to normalize for these earnings because they're not handed to you. It's not like public companies. You really have to do all of the digging yourselves. And really anything under the sun can be expensed in these companies. There's a recent deal where we looked at where they tried to put in the son's college tuition and the family's trip to Hawaii. So after that, we calculate free cash flow. So here it's really simple. We're looking at the cash in divided by the cash out and getting some sort of normalized return that's time weighted. So the basic calculation is normalized EBIT, or operating earnings, minus interest, minus taxes, plus depreciation or amortization, minus CapEx. It's simple, but very, very important. On to step 3 and 4. Here we adjust for leverage and synergies. So step 3, we incorporate the debt or leverage. Step 4, we incorporate operational improvement or synergies. And on to the final slide. Here we calculate the IRR. Does everyone understand IRR? It's basically the return you get on an annual basis. Technically, it's where the present value equals the future value. Calculation's simple. Use the IRR function on Excel. If you have cash flows that are not periodic, then you can use X IRR, and then you compare this rate to the hurdle or target rate, which is usually about 17 to 25%. If the IRR is greater than this rate, then you invest. If it's less, then you don't. Very simple, very straightforward. Let's move on to some additional details through an example.